Are we heading for a lost decade in the investment markets? Today we're going to talk about what specifically a lost decade means. We're going to look at the history of lost decades in the markets, and we're going to talk about what it might mean for you as a long-term investor. Okay, so what is the term lost decade? Well, in the investment world, a lost decade is another way of saying an extended period of time, typically around 10 years, decade, where you did not make any money. So essentially you had a lost decade. You lost 10 years of potential to make money, so you didn't make any money over that time period. So it's just essentially another way of saying the market did poorly for an extended period of time. Well, how often does that happen? Because it would be a real bummer to not make any money in the stock market over a 10-year time period. So how common are these lost decades? Well, let's look back at some history. We've got over 100 years worth of data here. This chart is going to go back a whole long time, and this is going to look at a balanced portfolio, or what typically people call a balanced portfolio, which is 60% stocks. Stocks in this case being the S&P 500, right? The 500 largest companies in the United States, and 40% bonds, publicly traded bonds. So a balanced 60-40 kind of standard portfolio that many people look at. How often has that portfolio not made money after inflation? Okay, well, as we look back, those blue lines that you can see, those all represent lost decades in the market, or when that balanced portfolio did not get positive returns after inflation over extended periods of time. And sometimes they're longer, like 19 years, the most recent one between 2000 and 2010. That was just 10 years, and your portfolio, if you had a 60-40 portfolio, 60% S&P 500, 40% publicly traded bonds, you lost after inflation 1.6% on average per year. What causes these lost decades? And there's not necessarily a cause, but what are some characteristics in the market from a lost decade? Well, the characteristics usually as a starting point for your stocks is the stocks are very expensive. So people have started to pay more and more relative to the earnings of these companies, and they're starting to overpay. And the more you pay for an asset, all else being equal, the lower your future rate of return. So you always want to get a better deal. So overpaying is the opposite of getting a good deal in the stock market. Well, what about bonds? Well, with bonds, it's a function of your starting interest rate. And so right now, as an example, the starting interest rate on your 10-year government bond is around 4%. And so if you have a 4% government bond, you have a 3% expected inflation, right? Your real rate of return might be 1%. So not amazing. And so if you look back over 100 years or so, the characteristics that might be present with either stocks or bonds are really expensive stocks or a low starting interest rate in bonds. And it just so happens currently where this, as you notice in this chart here, this started to dip blue in 2020. If you'll recall, stocks and bonds both went down in 2020. And, well, unfortunately, we had high stock market prices and we had low interest rates. And so if you look here, we had a 42 CAPE, which is the cyclically adjusted price to earnings ratio. Let me just summarize that and say that's very high. That's more than double the normal price to earnings ratio of the S&P 500. And then you had a negative 1% real interest rate in the bond market. Now remember, this is when rates were really low and you had low interest rates, but you still had inflation. So if you have an interest rate that's 1%, but you have inflation rates that are 2 and 3%, you actually get a negative real return. And so what's really unfortunate about the beginning of the 2020s is we didn't just have high stock prices or just have low bond rates. We had both. And so this blue line, the question is, how long does this period where now the markets have started to come back up, but we're just coming out of where we were several years ago in the market? And so does this blue line continue, or does this turn into a lost decade in the stock market? Well, where are we with the current stock prices? Current stock prices are still, when it comes to the S&P 500, pretty expensive. Well, what about long-term government bonds or publicly traded bonds? Rates are not very high from an interest rate standpoint. And so it's not impossible at all that we could be staring at a lost decade when it comes to the standard 60-40 portfolio of S&P 500 and publicly traded stocks. Based on history, these are the kind of numbers we've seen in the past. And so, okay, that's not great news. As long-term investors, what should you do with that news? Well, remember, the 60-40 balanced portfolio is the S&P 500 and publicly traded stocks. Well, that is not the investment universe. That is one piece of the investment universe. There are still smaller companies. There are international companies. There are different types of publicly traded bonds. There's short-term, there's long-term, there's public, there's private. And so more than anything as long-term investors, make sure that you are diversified. Talk to your advisor and say, what do I own? Why do I own it? Does this have the expected rate of return that I need to get in my long-term plan? Because there are many times in history when your standard 60-40 S&P 500 and publicly traded bonds have disappointed for an extended period of time. And you just want to make sure that you know going into it what those expectations are. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.